We often speak about fear and recession as if they're inseparable twins. When one enters a room, the other inevitably follows. Economic downturns prompt worry and anxiety, and that pervasive fear feeds back into deepening the recession. But beneath the surface, the relationship between these two isn't always direct, nor is it fixed. It involves third factors, powerful intermediaries that can reinforce, diffuse, or even reverse the momentum. If we learn to recognize these hidden players, we gain powerful insight into ways of breaking or reversing the destructive cycle. Let's take a journey through these subtle yet influential relationships, revealing how understanding them can reshape our collective economic resilience. At the heart of any recession sits uncertainty about employment, prices, future opportunities. Uncertainty doesn't just create fear, it sustains recession by paralyzing decisions. In times of confusion, businesses freeze hiring, consumers defer spending, and markets stall. Like fog on a highway, economic uncertainty blinds our collective path forward. Yet, intervention by governments, central banks, and institutions offers clarity. Timely market interventions, effective regulation, or strategic stimulus efforts can pierce uncertainty, illuminating economic pathways once obscured. This stabilization acts powerfully and simultaneously against fear and recession, dissolving their coexistence and re-establishing equilibrium. Intervention isn't a patch or a bandage, it's more like removing the fog altogether, restoring the confidence needed to move forward clearly and purposefully. Consider how fragile consumer confidence can be. A sudden loss of trust in economic stability pushes consumers into cautious retreat. They hold back on purchases and major investments, stalling economic engines. Fearful consumers mean declining profits, leading directly to layoffs and economic slowdown, a textbook recession unfolding. Yet confidence can be rebuilt. Strong and decisive economic policies, such as targeted stimulus checks, guaranteed loans, or job preservation programs, act like circuit breakers, interrupting the damaging feedback loop between fear and recession. A single, credible reassurance can halt fear-driven hesitancy, restart spending, and reverse economic contraction. Here we see clearly that breaking a negative cycle often means creating an opening for trust to return. Think about how rapidly market panic spreads. When fear grips investors, stock sell-offs ensue, triggering market declines that then reinforce and legitimize the initial fear. Panic selling cascades rapidly into broader economic disruption, leading to recession. In this chain reaction, fear directly triggers recession, but it's amplified by another participant: media coverage. The stories we tell each other matter immensely. The media can either amplify the panic or diffuse it. Sensational headlines breed fear. Responsible coverage fosters calm. When media pulls back from dramatization, it interrupts panic at its psychological source. By understanding the media's amplification role, we discover a powerful lever to prevent fear-driven recessions, reverting anxiety into measured response. The trauma of bank failures vividly illustrates non-linear economic dynamics. Fear initiates cautious behavior, leading to reduced spending, business failures, and ultimately, bank collapses. Bank failures then become dramatic symbols of economic crisis, intensifying public fear in an unpredictable cascade of consequences. But retrospective interventions, such as strategic bailouts or loan guarantees, create a counter-narrative. When people see banks restored and safeguarded, they interpret past fear through a new lens, as a temporary crisis rather than a permanent collapse. Re-establishing trust retrospectively can stabilize the economy even after a crisis has begun, highlighting the non-linear nature of recession and recovery. Few elements bind fear and recession together as closely as employment uncertainty. As fear builds, businesses slow hiring or initiate layoffs, fueling recession. This recession, in turn, feeds more fear and job loss in an inclusive downward spiral that leaves few untouched. However, introducing economic safeguards like universal basic income or enhanced unemployment protection can break this spiral completely. A reliable safety net severs the link between employment fears and recession, offering people stable economic ground. With a solid foundation, recessionary pressures ease, spending stabilizes, and fear recedes. It's a testament to how thoughtfully designed social policies can completely disrupt and revert fear-based economic cycles. Sometimes, the economy approaches a critical tipping point. High levels of debt default represent such a moment, immediately signaling a sharp downturn and stoking collective anxiety. At this juncture, fear and recession seem to flow directly from the same source. Yet effective monetary policy, the careful adjustment of interest rates, credit availability, or direct market intervention, can create a bottleneck, preventing fear and recession from reaching a critical mass. Think of monetary policy as controlling the flow of traffic at a congested intersection. By skillfully managing that intersection, policymakers prevent a chain reaction, stopping fear and recession from spiraling outward. Inflation often moves in tandem with fear and recession, creating a harmonic triad of destructive forces. When prices spike alongside recession, households face immediate hardship, intensifying anxiety and fear. Each force supports and deepens the others, generating self-sustaining economic turmoil. Conversely, wage growth introduces beneficial dissonance into this negative harmony. Steady wage increases reduce the immediate sting of higher prices, protect purchasing power, and gradually shift the perception from crisis to manageable challenge. Stronger wages break the synchronization of recession and fear, enabling consumers to remain calm and confident amid temporary setbacks. Recent global crises have shown vividly how quickly a supply chain collapse can merge fear and recession into an integrated disaster. Disrupted supply chains generate shortages, inflation, and panic simultaneously, dragging economies rapidly downward. But economies with built-in resilience, through diversified production, robust logistics networks, and agile market adaptations, can swiftly decouple fear from recession. Resilience reduces vulnerability, ensuring minor disruptions don't become full-blown economic disasters. Rather than converging, fear and recession dissipate independently, greatly limiting overall damage. Speculation creates unpredictable swings in economic fortunes. Financial bubbles can temporarily mask recessionary pressures or, conversely, intensify fear and hasten downturns. The result is a volatile oscillation, an unstable dance between fear and recession, driven by speculation. Innovation acts as a powerful counterforce. Technological advances often disrupt industries, initially causing anxiety, but ultimately creating lasting economic opportunities. Innovation breaks established patterns, interrupting fear-driven recession cycles and dividing the close bond between economic anxiety and downturn. When large corporations initiate layoffs, they powerfully associate fear and recession. Workers experience personal anxiety at the same time economies shrink. Such corporate action magnifies both fear and recession, linking personal uncertainty to broader economic instability. By contrast, robust local economies, small businesses, community banks, decentralized financial systems, disassociate personal anxieties from widespread recession. Communities with diversified economies and strong local institutions remain resilient in the face of larger downturns, shielding citizens from fear-induced recession spirals. Few crises demonstrate integration as dramatically as a housing market collapse. When housing bubbles burst, personal financial hardship combines with systemic economic failure, weaving fear and recession into a single devastating tapestry. Yet regulatory stability, prudent lending standards, and decentralized financial approaches act as barriers against this integration. Solid regulations and decentralization disintegrate dangerous connections, allowing temporary market declines without widespread financial panic or deep recession. Preventing systemic integration of fear and recession creates economic breathing space. Fear and recession aren't inevitable companions. Their interplay involves complex dynamics, influenced powerfully by third factors that can either amplify or dissolve their destructive bond. Recognizing these subtle patterns, we've seen multiple ways to reverse economic fear: thoughtful intervention, responsible storytelling, strategic policies, social safety nets, innovation, and financial resilience. Understanding these triadic interactions empowers us not only to predict fear recession cycles, but also to prevent and reverse them effectively. The future doesn't have to be written by anxiety and economic contraction. Instead, with careful thought and strategic action, we can reclaim control over economic narratives, transforming collective uncertainty into shared resilience and sustainable prosperity.